In today's session, we'll discover exactly how you can build your wealth with cash flowing assets with Freddie Rappina. Welcome to Awakened Titans podcast with Lily Patrascu, mind-blowing conversations with influential business titans sharing how you can manifest abundance, love, joy, success through quantum awakening, quantum manifestation, quantum healing, quantum miracles, exponential business growth, and innovative products and services. Freddie Rappina is a wealth advisor, chartered financial consultant, and accredited investment fiduciary who founded Opta Financial. He has extensive experience in the financial services industry, and he assists clients in assessing their current financial situation and setting financial goals, conducting thorough financial analysis, and providing actionable recommendations. The first question is, what's the best way for entrepreneurs to build wealth?
Well, that's a great question. Okay, so let's go over the mindset first. I think that's where people need to start, right? So I have this mindset standard where you're either going to be a checkers player or you're going to be a chess player. A checkers player plays it safe a lot, fully, funds retirement accounts, has a lot of market-based assets, counts on compound interest to kind of take care of a lot of the growth. And then you have chess players. Chess players are different. They not only do they invest in market-based assets, but they also invest in real estate. They invest in businesses. They invest in things that are going to cash flow to bring more income into their lives so they can live a great life now, not just in 30 years from now, as the checkers player is being kind of pushed towards in our financial world. And I'm not saying there's anything wrong with checkers. I'm just saying it's not chess. I'm just saying you can be happy you can retire playing checkers, but you're not going to become wealthy, in my opinion. That you're going to have to switch to chess. And your biggest difference, the thing that's going to separate a checkers player from a chess player, is their attitude towards debt. If you're playing checkers, you want to stay the heck out of debt. You don't want, including your house, pay off your house, to have no debt, live debt free, all that stuff. If you're playing chess, however, you actually want to get in as much debt as possible. When I say debt in this context, I don't mean like running up your credit card. I mean like using your assets as leverage to loans to buy cash flowing assets such as real estate and businesses.
Thank you. Can you share your journey towards building wealth?
Sure. I was a police officer for 20 years. Once I started getting around, I was a total checkers player. I was a complete checkers player, working overtime, stocking my retirement accounts, all that stuff. And then I started getting around chess players, people who were building wealth and were wealthy. And I realized that the attitude was different towards almost everything, and not just, advancing your lifestyle, but taxes and almost everything about wealth building. It was different. And so around my 12th, 13th year, I decided I wanted to start a small financial firm. And I did that, and I started off really small, and it got pretty big pretty quick. For about 6-7 years there, I had 2 careers. I was running, my financial office was right next to my police station. I was literally running back and forth across the street. And but I was able to retire from the police force, and now I just help people build wealth. And I really enjoy the process.
Thank you. What are the key principles to building sustainable wealth? What are the pillars for doing that?
Cash flow is the biggest, in my opinion. If you are building cash flow where you're getting income from multiple streams, and having the resources to be able to cover those assets, like if something goes wrong, you need to have cash reserves to be able to fix a problem. You don't want to be over leveraged, in my opinion, but having the guts to start and really build and have the mindset like, I'm going to do this a little at a time. I'm going to become wealthy for sure, not try to get rich quick. It's a process. And having the right mindset for me is the biggest. But do what they do, not just buy what they sell. So when I use they in this context, would be the financial services industry, like all of it. And I don't want just people to put money in a bank. I want people to put money in a bank and then do what the bank's doing, or put money into investments such as like mutual funds, but then I want you to do what the investment company is doing with the money. You can buy an insurance policy, great. But after you do that, what you're doing what the insurance company is doing to help for them to build wealth. You're just going to do it on a smaller scale, right? That's the idea that you have to play a completely different game than them, I believe is false. You just probably can't play it on the same scale as they do. It's you might be playing little league and they might be in the majors, but you're still playing the same game.
Thank you. Give us some examples of the type of activities that may bring cash flow, like recurring cash flow.
Real estate for me is the biggest, but you have to do it smartly and, in my opinion, not over leverage. But you should have the assets first, right? So you may have to play checkers first, right? And then switch over to chess. But in my opinion, most people are able to play in the real estate world at least a little bit and build slowly but surely up from there. I would say and easy is not the correct word because everything has its challenges, but I just believe it's something that most people can do. Not everybody's going to want to purchase a business or, and run a business or anything like that. But creating passive income through real estate, in my opinion, it should be considered by people who want to advance their lifestyles and build their wealth.
Thank you. So do you help people to find those kind of opportunities, or do you just have potential like joint venture partners that offer passive income property investment opportunities?
We help them through the process. So we are fiduciaries. We have to act in the best interest of the client. And so it really depends on them, what they are interested in. And we help them through that. So there's no one right way in all of this. There's plenty of good ways, but it's really going to be, okay, let's figure out which one is best for you. And what's going to meet your debt capacity. So debt capacity is like financially how much debt you can really handle, right? Then there's debt tolerance, and debt tolerance is how much you are willing to do, right? So there are two different things. So once we know those numbers, we know those concepts, then it's easy to like, okay, what are our options here? And we go through the pros and the cons of the options and we kind of figure it out. But nothing crazy though. No scams or schemes or anything like that. Just especially when it comes to real estate, we want people to actually buy the real estate, buy the assets, get cash flow from the income, learn how to depreciate the property correctly, and how to practice good tax avoidance. Tax avoidance is good and legal. Tax evasion, however, is bad and illegal. Don't do that. And the tax code is beautiful. It's set up for people to become wealthy as long as you're kind of doing what the government wants you to do.
Thank you. So do you have like a wide range of potential property investment opportunities? And based on the entrepreneur that's standing in front of you, you would kind of say, okay, these are the potential options that are best suited for your case. And therefore we recommend maybe this or this or that. Is that how it works?
So yeah, if once we have like an idea of what kind, like real estate, for example, right? So some people may want to invest in small single family homes first and then get into multifamily later as they kind of graduate through the ranks of the size of the property or the price points of the properties. And that is absolutely okay. I hear a lot of people say like, well, 20 years ago, I wish I would have gone bigger right away. It's like, well, you didn't. And that's probably one of the biggest reasons why you're successful, because if you make a small mistake on a small thing, that's a lot different than making that same mistake on something much larger, right? But whether that's going to be single families, multifamilies, or other types of real estate investments. But we do like working with people that want to purchase the real estate, not just invest in a fund that's doing it for them. Like it's not the same thing. And or businesses, right? Franchises or other types of businesses. People that are interested in building cash flowing assets through that is fine as well. And usually those cash flowing assets leads it back to real estate as well. So, people understand that the market isn't going to do it likely by itself. And we just had all-time highs. Who do you know that got rich? Who do you know that all of a sudden up and quit their jobs because the market was at an all-time high? Because the market doesn't create wealth like that. It's a great tool, and it's something that the lenders certainly like to see, right? They want to see that you have money on paper to be able to pay them back if you ran into trouble with your asset. But in my opinion, that's the best part about the market-based asset. Then they're going to go up over time as well. But being able to leverage and use other people's money to purchase the cash flowing assets. And when I say other people's money, that's usually checkers players' money.
Thank you. What are the most effective ways to diversify income streams in order to build wealth?
Okay, so you have diversifying over in asset classes. Okay, so and when I say asset classes, I don't mean just asset classes within an asset class, like stocks, bonds, mutual funds. Those are all market-based assets. Right, it's all one thing. So in this context, then you have real estate. Real estate's bringing in income. Then you have businesses. Businesses are bringing in income. Maybe you're a limited partner in a business and not, so maybe that's bringing in some income through like a K1 of some sort. So those are the biggest for sure. Developing that passive income through real estate or recurring income from businesses. Those are the keys right there. But you got to actually have money to be able to do this. This is not like something you can just, up one day and be like, I'm going to go buy a bunch of businesses. I'm going to buy real estate and I don't have any money. Like, no one's going to give you a loan, right? You're not a good bet. So you need to become a good bet first, and then use your opportunity as a good bet to start being an investor and doing things that, again, the government wants you to do, right? So if you're investing in things the government wants you to do, your tax liability goes down. If you don't do what the government wants you to do, your tax liability goes up. It's like a big coupon book, the tax code. And if you use it correctly, it can really be a big wealth building tool for you.
Thank you. If entrepreneurs have, let's say, $10,000 to invest, what do you recommend they do with that first $10,000?
I recommend that entrepreneur do whatever they need to do with that $10,000 to improve themselves so they can make $100,000. Investing that money in the market with even my firm, that's not going to get it. That's not going to do it. All right. And I guess I'm one of the few wealth advisors that will say something like that out loud. And you want to take whatever classes, get whatever training you need to be able to get that loan, to be able to start a big business or buy real estate. It's whatever you're going to do to improve yourself with that $10,000, assuming that they're starting out, right? Invest in yourself, believe in yourself, and invest in yourself with that 10 grand.
Thank you. Let's say that now entrepreneurs have reached 100 grand that they can invest. What would you recommend they do with it?
Okay, now we have $100,000 that's sitting to the side. Now, again, depending on their risk tolerance, and then we probably would want to get into some type of real estate investment, right? Something that's going to cash flow, something small, right? And build from there. And some of that money from that piece of real estate is going to go back towards the pot, and some of that cash flow is going to go in your pocket so you can enjoy your life now and go have a better vacation with your family or whatever you do to enjoy life. And I feel like that's definitely something that's kind of missed with a lot of people when they start becoming more successful and they just start spending the money. It's like, wait, no, buy the asset first. Buy the security of having that asset continuously bringing in the income, and then use that income to go enjoy your life. So people tend to skip that step, and and when the business doesn't do so well or falls apart altogether, then they're back to square one.
Thank you. What's the best way to protect your money from risk?
There is no way to completely protect money from risk. If you bury it in the backyard, inflation is your risk. So there's no way to completely protect money. But being educated and having a guide, having somebody who knows what they're doing, helping you. Even if you think you know what you're doing, it's always better to have somebody helping you because you get more brain power that way. And always focusing on making more money. That's how you keep up with inflation. You make more money. I hear it all the time. People should live within their means. right? And there's some truth to that, right? If you're playing checkers, you need to live within your means. But if you're playing chess, the goal shouldn't be to live within your means. The goal should be to make more means and live within that means. So you're always moving up, spending and earning, and you're always ahead of the curve, right? Otherwise, the inflation or any other type of market risk, whether the market goes down or something's going to come and bite you in the butt. So focus on advancing by continuing to build cash flow.
Thank you. How does it work in terms of working with you? Is it that entrepreneurs that make over, I don't know, 500K per year, is that the kind of entrepreneurs that you typically help to build their wealth? Or how does it work? Do you take a percentage or what's the deal?
Yeah, our firm, we do charge a percentage for assets under management. We are actually more affordable than the typical firm for a bunch of different reasons. We have some good partnerships out there. And the other reason is actually I know how to build wealth myself, so I don't need to bleed out my clients. We charge 0.6% for assets under management. The typical fee is 1% for assets under management. So that even though it's 0.6, that number actually has to be of something, right? But before that, you get all the services. There's no like upsell or anything like that. You're getting people who are going to help you on the journey. So that's our business model. We feel like if we give a lot of value, then we're going to get a lot of referrals, and we do. And people generally don't leave us.
Thank you. So does that mean that, let's say, if I have 100 grand to invest, do you take some of that money and do you invest for me in the market? Is that how it works? Or
yeah, so the money, the assets under management would be market based. We just don't stop there, right? So let's say you had $1 million, right? And we're investing that $1 million in market based assets, paper assets. We're charging 0.6% for those assets under management, but we're not saying like that is what's going to make you wealthy, right? That's going to go up over time. Typically the market goes up over time, of course, and we're going to diversify that, sure, but that is not what's going to bring you to the promised land. And again, we're one of the few firms that will say that out loud. It is the power that you now have because of those investments. We're going to help you take out loans to buy that cash flowing asset, whether it be real estate or businesses, and developing income streams. We feel like that's the way to wealth, not just investing in the market, even though we make revenue from that.
Okay, thank you. Is that a monthly fee or is that?
No, it's yearly.
Yearly. Okay, thank you. And what key factors should someone consider when investing in real estate?
Key factors, I feel like, especially if you're going to do like small real estate investments, you may not want your attitude to be capital appreciation. So you're not buying the properties with the idea that this is going to go up in value over time. I'm going to sell it for a higher value. That's capital appreciation, buy low, sell high. In the market-based assets, that's fine. If I'd rather you just never sell those market-based assets and just use debt, but that's for another conversation. But your attitude should be cash flow. Is the property cash flowing? Sometimes you don't want the property to go up in value. If it's in an area that it's like, oh, I can hit a bunch of these. I just need a few more months and I can get another one. Then in 6 months, go back and get another one. You don't want capital appreciation because if that house went up, so did the house next door went up in value. Now that house is going to be more expensive in 6 months when you try to buy it. So you actually kind of don't want your houses to go up in value in that context because you're trying to buy more to have more cash flow. Now, it's not a problem. It's a good problem to have when your house is appreciating in value, because now you can do other things like cash out refinance and purchase larger properties. But the mindset needs to be a little bit different when we're talking about real estate, because if we're talking about real estate, where the goal is cash flow. It's not like you buy a stock hoping the stock just goes up in value. You're buying it for the income. And if you're going to do multifamily, right, 5 units or more, that is a totally different thing. So because the value of that property is going to be based on the revenue that comes from that property, not what's going on around the building. So the comparables are different. So you want to purchase multifamily properties. If you're going to go that route, you have to have a different mindset than you did with the small single family houses.
Thank you. What are some creative financing ways to build wealth?
Okay, so when we get into creative, I start shivering a little bit because there are a lot of yahoos out there on YouTube or whatever, telling people that they can do these great crazy things, and I'm not gonna say they're all not true, but people should really take that stuff with a grain of salt too. You really want to build it correctly, in my opinion. And best way isn't creative, in my opinion. The best way is the way it works. That has worked, not trying to find some kind of life hack in there with the creative methods. I got another word for creative in there. It's two letters. So yeah, I just concentrate more on doing it the way that's tried and true instead of doing it creatively.
Thank you. What I meant was perhaps using credit cards to build your credit, or I don't know, something that could enable people to start making more money somehow so they can have that initial pot that they could use then.
Oh, I understand. I thought you were talking about like creative financing and stuff like that. Okay.
Yeah.
Yeah. So if we're talking about things, you need to develop your value. I feel like that's the most important thing. Develop your value, do something so well that people pay you a good amount of money, right? And develop a surplus, develop enough money so you can start the saving process to eventually start taking out loans, right? There's good types of jobs, in my opinion. One good job is one that pays a very high salary and you're easily able to live at a lower level and save money in some type of account, be able to develop that surplus very quickly. That's great. The other good job is maybe one that doesn't pay very well, but provides you with the training that you would need to start your own deal and like compete with your former employer because you have the knowledge to start your own business. Right. And it doesn't have to be something, ridiculously hard. It can be something like, a store, right? If you're working on a store, you learn how the store works and you can open up a similar store somewhere else. But developing that initial savings, in my opinion, it's the hardest thing about the process, in my opinion, is that first part of the saving and not spending it and not using it when you can. That's also a mindset thing. When you have the $100,000 saved, don't use the $100,000. Use a loan to purchase. You might have to put like some money down, like a down payment or something like that, but use the leverage that you now have to purchase that cash flowing asset. And because some people are like, well, I can pay it cash. I know you can pay it cash. You probably don't want to pay it cash because now all your cash is gone and it's sitting in the thing. Whereas if you take out a loan and that asset's creating cash flow that pays back the loan, you get to keep your cash, and that cash is in investments that are going to grow over time. And you don't create taxable events that way.
Thank you. I noticed from a long time ago when I was employed that it was a lot easier to buy a property, for example, if you're an employee than if you have a business. So I wonder what advice you have for entrepreneurs who are making a good amount, but let's say maybe the profit is not so high. Let's say you're making 500K per year, but let's say the profit is only 50K and you want to buy something. Do something with it to build your wealth.
That's a real problem. All right. When you have your own, let's say you have your own small business, you're solopreneur, you're doing something, you're making money, but you're also taking advantage of those tax breaks that are awarded to you. And you go to a lender and the lender says, well, you only make $15,000 a year. And you're like, bull crap, I make X amount of dollars a year. I just showed that at the end of this, I made at the end of the 1040, yeah, I'm only liable for $15,000 for my taxes, but you need to find a better lender. Don't get stuck with all lenders are the same and all lenders are going to look at that the same way. You need to find somebody who understands. No, it's fine that you wrote off stuff that was ordinary and necessary for the business and still be able to get that loan. So yeah, I mean, but that's a real problem, especially when people are trying, self-employed people are trying to buy even a personal residence and they get hit with that crap. It's find other lenders. Not all lenders are created equal. Just because one person said no doesn't mean that they're all like that. And
Yeah.
we work with some lenders that are way more open to that than others.
Thank you. So what do you suggest, for example, for self-employed people or people who have their own business, that perhaps imagine if you're an employee and you're making 50K versus, let's say you're making 500K per year as a business owner, but then your profit is only 50K. So in this scenario, an employee is better viewed from the point of view of a lender than a person who has made a lot more, but of course, like there's the profit is only 50K. So
how much did this person pay themselves in this scenario?
I mean, I don't know, but
Okay,
is that relevant as well?
that's incredibly relevant, right? So, if the business is generating that kind of money, but there's only like actual profit of $50,000 total after all expenses, and I don't mean like tax write-offs. I mean like expenses are going out. $450,000 of expenses going out the door, and you're only left with $50,000. I think you need to look at your business a little bit better because something's wrong there. But if you are in that scenario where you have a lot of business expenses, but those expenses are ordinary and necessary for the business, and at the end of the day, you are making money, but you just have a lot of tax write-offs. That's what I'm talking about. Like, well, don't believe every lender you talk to that says no.
Okay, so I mean this was just an example to understand what a potential entrepreneur could do. But basically, your solution is to just look at other lenders that might be more amenable to giving you a loan.
Yes, absolutely. Yes, the whole let's say you made $100,000 as a W-2 employee versus that same $100,000 as a small business owner. I mean, we're talking about taxes now, right? And we're talking about like how the W-2 person's it's going to be easier for that person to get like a primary residence home, right? Yes. And I don't understand that. I know it's a pain for a lot of entrepreneurs. We've even had people clients that have gone through that. So we get it, but it's all about making sure that you can get that other property. And the other way of doing this is actually renting and purchasing properties elsewhere. I mean, that something has to be said for that. That's not like a bad thing, as long as you're buying well and that rent is covering the rental income is covering your rent. And now it feels like you're renting for free. And sometimes you can use what's called a debt service coverage ratio loan to purchase those assets. So the income no longer becomes a problem. You might pay a higher rate for the SCR loan, but the income from the property is what supports the loan, not your income. There's no perfect way. I think everybody needs to kind of figure out who they are in those scenarios, and we work with them to figure out which one's going to work.
Thank you. So what I'm getting from what you said is that you have to kind of put your eggs in multiple baskets and make the most of it, and also do your best to raise your first 100 grand, and then from there on, they can start working with you. Is that right?
It's really about the mindset. Once they have the right mindset, things fall into place, right? So having that mindset, developing that, having that good solid base. Sometimes, like I said, sometimes you have to play checkers first. Don't feel like you need to just jump the chess right away. But if you're a solopreneur and you're like just starting out, and you're building, play the checkers game for a little while, but just understand that you're doing it so you're building that bridge, so one day you can cross over to the chess game.
Follow us for more interviews with world's most influential business titans, providing you with the insights to awaken to your full potential, so you can get paid to be yourself, find true happiness, and manifest anything you desire.